Welcome to today's market report.
European shares fell on Monday after weaker-than-expected growth data from China hit luxury stocks, while a relentless surge in commodity prices fueled worries about inflation spiraling out of control. The Pan-European Stoxx 600 index fell 0.5% after an upbeat start to the quarterly earnings season drove its strongest weekly performance since March on Friday. The index fell after 3 straight sessions of gains, over which it jumped about 2.7%. Equities fell globally after data showed China's economy hit its slowest pace of growth in a year in the third quarter, hurt by power shortages, supply chain bottlenecks, and the major wobbles in property markets. China exposed luxury goods, including LVMH, Kering, and Hermes, fell between 1.4% and 2.4%, also hurt by Chinese President Xi Jinping's call for the expansion of a consumption tax. But analysts are expecting European companies to report a nearly 47% jump in third quarter profit, as per Refinitiv. Those figures have been revised higher in recent days, helping the Stoxx 600 inch toward its August peak. When we look at the outlook in the next 12 months, valuations may come down a little bit, but not enough to offset the move higher that we see in earnings, and that should be pretty positive. According to JP Morgan, Belgium's Umicore was among major laggards, falling minus 3.9% after it cut its profit outlook to reflect a stronger than previously expected impact from the global semiconductor shortage. French biotech company Valneva shoot up 32.8% on positive results from a late-stage trial for its inactivated adjuvanted COVID-19 vaccine candidate. As crude futures rose past $85 per barrel, European oil and gas stocks capped losses, but Europe's gas squeeze looked set to continue as Russia's Gazprom showed no sign of hiking exports to the region in October. London's FTSE 100 retreated from near 8-month highs after investors bet that the Bank of England plans back-to-back interest rate rises for its November-December meetings, with more to come next year. The signposts all seem to be pointing to a November rate rise, which has helped drag down UK markets, according to AJ Bell Financial. What's certain is that rising rates can't do anything about supply issue. The Hut Group rose 20.5% after the British online retailer, backed by SoftBank, said it would remove its founder's golden share and seek a premium listing after its shares plummeted last week. The British pound is sliding 0.23% on Monday, trading at 137.12. Surging energy prices, high inflationary pressures witnessed on the last CPI readings in developed countries' economies, and the central bank's tightening monetary policy dented the market sentiment. The dollar index advances 0.04%, sits at 93.99, underpinned by US T-bond yields rising, with the 10-year note up 1 basis point at 1.586%. Over the weekend, on a panel organised by the Group of 30, Bank of England Governor Andrew Bailey said that while the central banks don't have the tools to counter supply disruptions, officials need to prevent higher inflation expectations from becoming permanent. Furthermore, Bailey added that rising energy prices mean inflation will last longer than expected. Additionally, said that we at the Bank of England have signalled, and this is another signal, that we will have to act. But of course, that action comes in our monetary policy meetings. That said, since 9th of October, when BOE's members Michael Sanders and Andrew Bailey expressed concerns about inflation and the central bank reaction, the British pound rallied from 135.67 to 137.72 on investors' expectations that an interest rate hike is on the cards. Euro-dollar advances 0.07%, trading at 116.10. Market sentiment conditions improved despite a weaker than expected third quarter GDP printout of China, rising inflationary pressures, and central bank tightening monetary conditions expectations. Investors flew through safe haven assets, mainly towards the US dollar, but as the market improved, the euro-dollar pair reclaimed the 116 level. On Saturday, ECB's President Lagarde said that the ECB is paying very close attention to wage negotiations and other effects that could permanently drive prices higher after delivering 2021 per Jacobson lecture at the IMF.
This is today's market news. Thanks for listening. We'll see you next time.